So, where did I get this idea of rating stocks from? I want to give you a little background so that you can really better understand my thinking. This is the Can Slim approach from William O'Neill. Again, he is founder of Investors Business Daily. He wrote the book How to Make Money in Stocks, which is a great, great book. And he values stocks mainly for investments, not definitely not day trading and not even really swing trading. So this is his approach. These are the indicators that he thinks matters most. C stands for current quarterly earnings per share. They have had to have spiked big over the past year. A stands for annual earnings increase over the past few years. The N, excuse me, stands for new products, new management, or new highs for the stock. The S stands for small supply of stock and great demand. L stands for leader stocks, not laggard stocks in an industry. The I stands for institutions are ideally invested in the company. And then M stands for market overall direction. But remember, he is holding stocks for several weeks, months, even years to fit these qualifications. And frankly, it just hasn't been working the past few years. Investors Business Daily has actually recently changed from a daily newsletter to a weekly newsletter just to show you how it's not really working as well as it once did. Here are some more specifics. The C is ideally 18% plus annual earnings growth year over year. He has specific numbers that he likes to see. The A, the annual earnings should have increased 20% plus over the past few years. The N, with the new products, new management, or new highs, kind of self-explanatory. The S is really interesting, where 95% of the winning stocks that he studied had less than 25 million shares outstanding. For you newbies, shares outstanding is how many shares a company has out there. So you get the company's value when you multiply this current stock price times the shares outstanding. So if the stock is, let's say, trading at $10 a share and it has 25 million shares, you multiply 10 by 25 and you get a market valuation of $250 million. If you want to find these big winners that William O'Neill liked, most of these companies are rather small. You know, whether the stock is trading at $5 a share, $10 a share, even $50 a share. 25 million shares outstanding is not that much. It's rather small. There's a great, hilarious movie. It's not a great movie. It's hilarious that the movie was even made by bitter Sirius satellite radio shareholders who were angry that despite the popularity of Sirius satellite radio, their stock price would not go up. And they blame short sellers. They said it's a whole conspiracy. I mean, it's a whole movie based on ignorance. It is ridiculous. What is it called? Stock shock or something? And I couldn't help but laugh like the whole time I saw it. Guys, Sirius satellite radio was not some kind of conspiracy by shorts. It was because the way that they made the freaking satellite radio, it's because they loaded up on debt and the company has billions of shares outstanding. So it's very tough to value this company at tens or hundreds of billions of dollars when they're just not, frankly, worth it. So pay very close attention to shares outstanding. I agree with William O'Neill on that, and we'll get into more details, more specifics. I think that I can narrow it down even better. L, leader stocks relative strength grades of 80 to 90% or better. There is a technical indicator out there called RSI, relative strength, and it just basically grades stocks on how strong they are compared to other stocks. And he likes it when they're 80 to 90% or better. I don't use RSI. I think I have better indicators, but that's just me. Where it's the institutions that are invested, William O'Neill says at least 3 should be invested, just to give it some respectability. And then the M, which I think is William O'Neill's biggest downfall here, the market overall direction, ideally only in uptrending markets. Because he's a long-term investor, because 3 out of 4 stocks follow the market, if you're investing in companies and you want big run-ups, it should be in an uptrending market. It's very difficult for, no matter what your product is, for the stock, no matter how hot the product is, for the stock to uptrend in a down, severely bearish market. And frankly, even though this is one of my influences, I think that I've made this kind of formula a little better for bull and bear markets and for short and long term plays, because you should not be only profiting in bull markets. We have a lot of bear markets sometimes, and I profit fine, in bear markets. And I think that's the way that it should be. Another influence for my indicators is this man, Gregg. He is the #1 trader on Profitly. He now runs some hedge funds, so he can't share as openly as he once did. He also spoke at a few of my conferences over the past few years. But here is his Profitly chart of over $10 million in profits. You can see all of his trades, and he can't share, again, legally right now because of, once you're a professional hedge fund manager or fund manager or analyst, once you're in the financial industry, they kind of clamp down on your freedom of speech. It stinks, but it's true. But the good news is you have nearly $11 million in profits to learn from him. And from what I understand, he's closing in on 20 million now. So he's done well the past few years too. But this is just a good example. He knows what he's talking about. You might have seen his speech if you've been to my previous conferences, or if you watch my How to Make Millions DVD. And in that DVD and in that video, he explains a few different setups. And I guess I'll include that video at the end of this guide too, just so you can have some more background. But he breaks his potential trades into this star rating system where a stock might be tradable if it's rated 1 star. It might be a good trade if it's rated 2 stars. It might be a great trade setup if there's 3 stars. Then some trade setups are 4 stars. And then he also has the best of the best, which are 5-star trades. And I really liked him breaking it down into this rather than just buy, hold, or sell, which is what most people want and what most people do on Wall Street. I really believe that there are better trade setups than others. And that's not to say that, a 1 or 2 star setup won't be a home run. It's just that, you have to try and really focus on what works. And you'll find that if you do this long enough, you'll find patterns that work again and again and again and again. And when you see that reliability and that consistency, it's not always going to work. You're not going to win 100% of the time. Even Gregg, if you look at his trades, he's winning 65% of the time. So don't come in here expecting 100% of the time. But when you do have these amazing setups, that's when you can take bigger positions. You can have more patience, and ideally you're really focusing on these, great trades. I'll give you an example that I'll detail later though. I bought TOPS the other day at $2 and $2.28, and it was already up like 40% on the day. It was holding its gains pretty well. No news, but in this current market that I'm filming in, low float, low market cap stocks, just small companies are spiking every single day. So, and they're not just spiking for one day, they're spiking for 2 or 3 days. So tops I bought at the end of day 1 thinking that it might spike on day 2. If I had to use Gregg's rating system, if I wanted to be honest, I would only rate it a 2. It was a good setup. It was not great. It was not the best. My first millionaire student, Michael Good, who's in my chat room, actually said, you know what, Tim, and to everyone in the chat room, I don't like this trade setup. And I wasn't that surprised. I wasn't offended. But, in this market, it pays to be aggressive because, like William O'Neill, I too agree that the market direction should influence your trading. And in this strong bull market that we're in right now, I'm going to be aggressive, even on good setups. And I totally underestimated it. Michael Good totally underestimated it. The thing doubled the next day. I sold for like roughly 30% profits, which is pretty good for me overnight. But when a 2-star setup can become 100% winner overnight, you know that you're in a hot market. So it's just an example that, some of the biggest winners don't necessarily have to be 5-star setups. And we'll get into my own ranking system in a little bit. I just want to make that point clear. And in fact, I came up with a name for my own ranking system. You might laugh, but I take it seriously. I call it the Sykes sliding scale, the SSS. And this is the logo that I designed. This is logo number 27. I went through 27 different versions of it because, again, as my stocks to trade programmers say, I am Princess Tim, and the princess must get his or her perfect logo. So this is my logo. This is what I've come up with. I don't have a fancy, crazy sounding name like CanSlim. My indicators line up to spell the word prepare. And I think that's fitting because that's what these indicators do for you. The P stands for pattern and price. The R stands for risk reward ratio. The E stands for ease of entry and exit. A lot of people don't think about this, but you might have the best trade in the world, but how easy is it to get in or out of the trade? The second P is for past performance and history of spiking. Past performance of, volatility. I want stocks that move. I don't want to trade boring stocks. A, which is something that I guarantee you very few people think about before they put their hard-earned money to work. What time of day is it when you're making the trade? What's your own personal schedule? Now, in my trade alerts, I include what I'm doing that day, where I am, because that influences my trading. Some people think that I'm just like trying to make small talk or make excuses. I think that it actually matters what you're doing, and we'll get into that. And it matters, pretty important way. The second R is reason and catalyst. Why is the stock up or down? What is the reason? What's the catalyst behind the move? And then E stands for market environment. And unlike, William O'Neill, where he just has the simple rating system, I actually value different indicators differently. Pattern and price is one of the most important, and I value it 1 to 20. You might have the perfect company and the perfect news and the perfect market, and it's the perfect time of day, and it has a great history of spiking. But if the price has already moved too much, it's not going to be a good trade. Risk reward ratio is also rated on a scale of 1 to 20 because you might have this great potential reward, and most people only look to see, oh, what can I make on this? How much can I make? And you don't consider the risk. Is it worth possibly making $1,000 or $2 for potential reward if you're risking losing $5,000 if the stock gets away from you and moves too fast and you can't exit in time? I would say no, and we'll get into that in a second. Ease of entry exit is on a scale of 1 to 10. Past performance is on a scale of 1 to 10. What time of day of it? Excuse me. What time of day is it? And what's your personal schedule? That should be a 1 to 20. The reason and the catalyst behind the move is a 1 to 10, and the market environment is 1 to 10. If you'll notice, there are 7 different indicators, and some of them are 1 to 20, most of them are 1 to 10. They add up to 100. I wanted to make it nice and easy so that you can judge a stock based on, this stock, if you add up all of its indicators, it's an 88 out of 100. That would be good. For me, that would be like the best of the best. So this is the Sykes sliding scale, the SSS for short, and they are the 7 key indicators I judge before every single trade. But remember, I am not perfect, okay? I am very far from perfect. Sometimes I forget about my own personal schedule. Sometimes I forget about, something that the company is doing, like if they're going to have, I don't know, if they're presenting at a conference later that day. Sometimes, I just forget one or two, and I'm going to try my best, but this guide, frankly, is not just for you. It's also for me. When I go into losing streaks, which happens sometimes, or I get sloppy with my trades, I gladly, willingly go back and review my guides. The other day, I got a little sloppy. I made a few $1,000s, but frankly, I didn't execute my trades well. I chased some trades a little too much. I wasn't happy with myself, and so I sat down and I went back through my Spikeability DVD. And the next day, I came back, more refreshed and better prepared. So I don't think, no matter how much money you've made or how many years of experience under your belt, I don't think you're ever good enough to not go back and look at the basics every now and then. It really helps you, stay humble and keep your mind right. Because the moment that you think that you are too smart or too rich, not to go back to the beginning, that's when the market will humble you and help you realize it. So, also, I have to tell you, this is not an exact science. I know I've mentioned it before in all my DVDs and video lessons and webinars, but it's just not. I know you want an exact formula like, okay, every stock rated 90 out of 100 will do well. It won't. Sometimes a trade that might be 50 on my 100-point scale will still do better than something that's rated higher. The stock market is somewhat unpredictable. So don't go in thinking that this is an exact science. Even the best setups, even the best trades that you are so sure of can turn into losses. So that's one reason never to go all in, but also that's another reason not to use leverage and bet too big, because you can be wrong and you can be wiped out. Remember, all it takes is one bad trade and you are done. Your confidence, your account, all gone. Credibility, gone. So these are the indicators I've refined over the years, and I think they do help increase your odds of success. That's what this is all about. While you cannot win 100% of the time, you can increase your odds. You don't have to listen to ugly bald men on TV and win 30, 35, 40% of the time, as too many studies have shown. You don't need to go to Vegas and play games where you win 30, 35, 40, 45% of the time, where if you win, again and again, you feel like you beat the odds and that you're special. We are not special. No one is above mathematics. No one is above odds of success. Unless you're cheating, okay? And I don't cheat. So this is real. And I do think that if you have enough indicators, on your side, the odds of success are in your favor. Whether you win 5 times out of 10 or 6 times out of 10 or 7 times out of 10. You're never going to win 9 times out of 10 or 10 times out of 10. I'm sorry. That's just not how life works. So the good news is that if you remember correctly, taking high odds trades over and 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 over, well, that leads to wealth, even when sometimes you're wrong. Because ideally, when you're wrong, you're cutting losses quickly. So your losses should never be bigger over time than your gains. At worst, though, if you somehow hate these indicators and you don't want to think about it and it hurts your brain and you're just like, I watch this, but I hate it. Oh, that might happen. But at least these indicators will slow you down from over trading and get you thinking more on every single trade before you risk your hard-earned money. That is a big problem for a lot of people. It's a big problem for me. Some days I go into over trading. Yesterday I made $4,000. And guess what? I wasn't too happy with myself, because even though I made money, even though I was right more than I was wrong, I had some losses. I had bigger gains than losses. I was sloppy. And, I overtrade sometimes because, I think it's just a natural kind of thing when you see so many plays and so many potential setups and you're just like, oh, I want to try this. I want to learn. But as you'll learn over time, you don't need that many trades to actually make a lot of money. In fact, the scalpers that I know and some of the people who make, 300, 500, 1,000 trades in a day, and they're trying to catch these plays for 2 cents here, 5 cents here, make a few hundred, make a few thousand over the day. Well, guess what? That's a very tough line of work, even when it's working. And when a stock, for whatever reason, blows through your stops or you can't get out in time and you lose 2 weeks or 2 months worth of scalping very quickly, it's not good risk reward. So I want to help slow you down. I'm no friend to brokers. Brokers want you trading more because they want your commissions. I want you trading less because I want you to be successful. And I know the PDT rule prevents you from doing more than 3 day trades per week. And a lot of people are like, oh, I want to do more. Well, first of all, if you hold overnight, it's not a day trade. So you can hold overnight every single night. There's added risk overnight, but at the same time, you can trade every single day overnight if you wanted to. Secondly, there aren't that many great setups. Even in this strong bull market, you don't need to be making 20, 30 trades a day. The best setups will pay you more than enough and you'll have free time. So just remember, these indicators are there to help you and help slow you down from the degenerate gamblers that I know many people are. So at best, these indicators will help you identify and execute the best trades possible. That is my hope for you. I want you learning, this is a good buy. This is a better buy. This is the best buy. I will fully expect to expand on this guide in the future. This is just the first step. Okay, so picture MS-DOS in the beginning of computing. Maybe not the true beginning, but the beginning of retail computing. And this is an idea that I've had for a very long time, but I think I'm finally ready to share it with you and teach it to you. The more indicators that are on your side here on my little Sykes sliding scale, the higher your odds of success. If the indicators are conflicting, it is often best to avoid that trade setup. And we'll go into, what it means to have all the indicators on your side versus indicators that are conflicting. But remember that 90% plus of traders lose, and it's due to a lack of preparation, it's due to a lack of strategy, it's due to the wrong mindset, and a lack of patience. And I think that these indicators will help you on all fronts. So you don't want to be the masses in this industry. I don't want you to be the masses, okay? You have to think differently, you have to trade differently, and then you'll get different results from everybody else who's doing, the same bad things, namely trading too much, chasing stocks, not being self-sufficient, not being prepared ahead of time. So most SSS indicators are valued on a scale of 1 to 10. As I said, 10 being the greatest, 1 being the worst. For example, in a bull market like right now, market environment is a 10 for longs or a 1 for shorts. As I said just a few minutes ago, I took a trade the other day that I knew it wasn't the best setup, and we'll get into it. But I was, really just confident in it and enough to hold it overnight because, frankly, the market rewards me right now. In a different market, I wouldn't be that aggressive. So it's important to know what market you're in. Remember, 3 out of 4 stocks follow the market at all times. Price/pattern, time of day, and risk reward are most important though. So they are valued on a scale of 1 to 20 as opposed to 1 to 10. But long story short, if all the SSS indicators are perfect, it will add up to a perfect score of 100. And if all the SSS indicators are terrible, it will only add up to a 10. So somewhere in between 110 is where these setups are going to be. And I really would prefer you only to take trades on highly valued SSS setups. Ideally 70 to 100. The higher the numerical value, the more aggressive I will be, and I'll be displaying more patience, and I'll have a bigger position size. A lot of people ask me, how do you determine position size? Why are some trades big? Why are some trades small? Well, I never really had an exact answer until this Sykes sliding scale. So I'm really proud to finally be able to present it to you because, you can never just judge a trade based on any one indicator, or even 2, or even 3, or even 4 in my mind. So I had to first teach all the indicators, which I have in previous guides. And now, we're taking it up a level. We're taking it up a notch to teach, what indicators matter more and how to kind of value all of this in your head. If the total SSS score is only mid-range, though, between, let's say, 30 and 70, it's probably not worth trading, and I'll likely avoid it. Sometimes I'm undisciplined. Sometimes I'm just like, it's the right market, and I'll try something with a small position. But I really should stick to higher numerically valued setups. Again, this is not a perfect science, so don't think that this is perfect. Something rated a 30 could very well be a great pick, but this is a scale that hopefully will make you into a more profitable trader. And I'm only introducing this now after 8 years of teaching because, frankly, I'm getting better as a teacher, and I'm seeing what will really help you guys, and I think that these indicators will. It's taken me a while to get to this point. I wish I could go back in time and have learned all the things that I've learned about students in the beginning, but you live, you learn. And it took me a while to learn trading, and now it's taking me a little while to learn teaching. So hopefully I can speed up your own learning curve. But I am not a math whiz. Okay, I don't want you to think that I'm so smart or so good at math that I have some kind of advantage. Um, I'm saying this not just to humble myself, but because I want you guys to improve upon this scale. I'm throwing it out there to kind of open the floor to suggestions. I want all you programmers, all you quants, all you geniuses, all you math whizzes, take these basic guidelines and let's see what software, signals, alerts, tools, websites can be created. And I want to work together. Stockstotrade.com, my software, has been created in participation with one of my students who was a programmer, and he was fed up by me being so disorganized. And he worked hard, and we've created Stocks to Trade, and that's fantastic. So I'm excited to see who contacts me. Again, email admin@timothysykes.com with your ideas, and we'll work together, because this is just an outline of indicators used all in conjunction. And I can envision an entire new realm of quotes that don't just have, streaming stock prices, but streaming indicators as to, how good this setup will be, at 9:50 a.m. Eastern versus how good this setup will be valued at like 10:05 a.m. Eastern. They'll be moving differently based on the price, based on the pattern, based on the volume, based on all the indicators that I teach. So I'm excited to see where this goes. But the goal for everyone is to be better prepared on every trade, because that leads to higher odds of success, and that's the name of the game here. All my top students and I, we don't win 30, 40, 50% of the time. We win 50, 60, 70, 75% of the time. That is the difference. And on top of our bigger percent wins, or our, more wins than losses, our percent wins are actually bigger than our percent losses. So it's very tough not to grow your wealth in your account if you're winning more than you're losing, and your wins are bigger in dollar amounts than your losses. And that's why already in 7 months of 2016, my $12,000 account has grown to a little over 70,000. So the overall stock market is up, I don't know what, like 5-10% on the year, and my account is up ridiculous amounts, like hundreds of percents. And it's because, frankly, I'm taking good trades, and I'm being rewarded by this insane bull market. So if you've seen my previous guides, well, then you know my patterns. I will get into them in a second, but pattern and price is valued 1 to 20 because this is probably the most important indicator out of all 7. The better the pattern and price action, the more interested I become in a trade. And I want to make this very clear that, I have some very distinct patterns that I've talked about in my previous guides and that I see every single day, and I like to stick to those. Tim Grittani, my second millionaire student, in his DVD, Trading Tickers, he talks about his favorite patterns. We all have our own favorite patterns, and your favorite pattern might be different from my favorite pattern. This is what makes teaching so interesting and so difficult, frankly. So there's not any one right pattern. It's what is the right pattern for you. Some of us like going long, some of us like going short, some of us like holding a day, some of us like holding a week, some of us like holding an hour. It's whatever suits you. The stock market and stock trading should be made to be comfortable for you. You should never be uncomfortable in a trade. If you're ever uncomfortable, just exit the trade. Problem solved. This can be a very fun game if you follow the rules, and a very good business if you actually really follow the rules. But too many people think that they have to do things a certain way that, just doesn't jive with them. Some people are really naturally optimistic people, and they don't want to short sell. And I get that, okay? They don't want to bet on failure. They don't want to bet against scams. No one is forcing you. And then I know some really cynical, really negative people who say, every penny stock is a scam. I can never buy anything. And they just want to short everything. So their favorite patterns are all short selling patterns. that's fine. Okay. For me, I look at it like a forehand and a backhand. I want to be able to go long. I want to be able to go short. I want to be able to do both. But at the same time, I've seen so much junk over the years and so many lies from these companies and their management. I'm primarily, you know, I favor short selling. But at the same time, this year I've been growing my account because I've learned how to go long too. I made my first million buying, I made my second million shorting. So just try and learn what patterns work best for you and your personality. And I'm going to share with you a lot of my patterns and Tim Grittani's patterns coming up. And you can see, or hopefully you'll be able to see, that no matter whose pattern is, what, no matter whose favorite is whose, at least we have reliability and consistency. We recognize, okay, this is my pattern, or this is one of my favorite patterns. I'm not just veering off and trading random stocks that trade randomly. I give trading challenge webinars every single week, and there's like a lightning round where people ask me, what about this stock? What about this stock? What about this stock? And most of the time I'm saying irrelevant, irrelevant, not my pattern, not my pattern. So for me, I know my patterns, and I'm about to share with you. I want clear breakouts over recent highs, over multiple time frames, whether it's 1 week, intraday, 1 month, 1 year. The more time frames, the better. And that makes it, more reliable. And the same thing with breakdowns on the way down. You have to try and think about all these different traders all over the world looking at different patterns, and they're using software that scans for different kinds of technical events. Like there's software that scans for stocks hitting new highs of the day or new 52-week highs. But if a stock is hitting, let's say, new high of the day, new 52-week high, new weekly high, new monthly high, new 5-year high, well, that's a pretty strong stock. And that's going to be strong to everybody. That's going to be apparent to everybody. As opposed to choppy stocks that just zigzag all day. And, they're going to be rated low on my pattern scale because they can't make up their mind. So neither can I. If there's a stock that breaks out, oh, it's a breakout. Nope. 2 minutes later, it's a fake out. Oh, it breaks out again. Nope, it's a fake out. Oh, it breaks out the third time. This has to, nope, it's a fake out again. I don't want that. Okay? Trading is hard enough. Why make it harder by trading patterns that, just are too choppy? So I don't do well with choppy stocks. I know there are some people who like the choppiness and maybe it like tingles their gambler instincts. I don't like it, especially because I cut losses so quickly. So if a stock that I think is going to break out doesn't keep breaking out and it goes under resistance, well, then I get out. I exit and I trade safely, even if it breaks out later in the day. And also, sometimes a stock will barely break out or barely break down. Like the previous high is, let's say, I don't know, $5 a share, and it goes to like $5.07, and then it comes back to like $4.94. So it is technically a breakout, but then it fails. That's not good enough for me. Okay, I want convincing patterns. If I think a stock is going to go from $5 to like, let's say, $6 a share, it should be able to break out more than just 7 cents a share. I mean, I want to see some real commitment, and if it doesn't happen, I get out. So if you see a lot of my trades, a lot of them are these 5 or 10 cent a share losses or gains. And it's not because that's what I'm aiming for. It's because I'm out. It's a scratch. The pattern, the price action was not good enough for me. It doesn't earn my hard-earned money. Or if I put my hard-earned money in, it doesn't stay there very long because it doesn't deserve it. That's how I look at it. And you have to remember, I'm like the most cowardly, scared trader you'll ever meet. And I think that's a good thing because I'm trading crazy volatile penny stocks. My critics will say that I only trade, quote, gimmies. And guess what? I don't deny it. They are right. I want the easiest, most obvious chart breakouts and breakdowns in the entire market. I'm not interested in these, attempted breakouts or attempted breakdowns. I'm not interested in charts. Oh, my bad. I said chat. This should be chart. There's another mistake. Anyways, I'm not interested in something that looks difficult. If it looks difficult, I just get out. Remember, I am not that smart. I am not that good at math. And if I'm going to have a big win, I'm going to know pretty soon, you know? Like, even though my TOPS, the example which I'll detail in a little bit, wasn't that great of a trade setup where I made 30% overnight, it closed kind of nicely. Like, at worst, I was down 5 cents a share on the stock. So I wasn't really tempted to get out of it. And overnight, the stock was uptrending and I was up 10 cents a share, then up 20 cents a share, then even up 25 cents a share after hours. So it was going in my direction all after hours long. And that made me feel more comfortable. And, it wasn't necessarily a gimme, but it was heading in the right direction. So it was pretty obvious that it was in play the next day, and that's what I like. The clearer, the more obvious the pattern, the more likely other traders will be interested in taking the exact same position. And as I'm hopefully going to teach you, with enough preparation, you can beat them to it by recognizing and spotting, oh, this is an intraday breakout. Oh, it's not just an intraday breakout, it's also a 1 year, 2 year, and 5 year breakout. By looking at the past, guess what? You're better prepared. This is why I have so many video lessons. I'm basically a glorified history teacher. So, for example, if a stock is breaking out to new highs on the day, new highs on the month, and new highs on the year, it'll pop up on a ton of traders' technical scans. And all of those traders have been taught to buy breakouts, or most traders. Some traders are just like, there's too many traders in this. I'm just going to go against the crowd. Well, guess what? Most traders like to buy breakouts. So they just need to be aware of this ticker, whatever it is in this hypothetical example, and then they might buy it. And if they might buy it, somebody else might buy it. And if somebody else might buy it, then somebody else. And the whole trader mob might buy it. And that's what creates this self-fulfilling prophecy. But remember, price and pattern is not the only indicator I consider, but it is one of the most important, probably the most important, and it can tell you a lot about a potential trade. And it is kind of crazy, but the patterns that I trade have not changed at all the past 2 decades. I really thought that there would be a little change, but nope, nope. The breakouts and the breakdowns are the exact same. And I think it's because human nature never changes. Jesse Livermore said that. He said the stocks change and the players change, but the patterns never change because human nature never changes. And I agree with that. It's pretty remarkable. So you can learn these patterns, not going to be like exactly the same, month in, month out, year in, year out, but the vast majority of the pattern, like the gist of the pattern, it's pretty much the same, as you'll see. I'll give a few examples coming up. I also say, this is important. I don't want to buy random patterns or at random prices. There's a lot of people, they see news or they find a stock, and the stock, maybe it's in the middle of the day or it's mid-range, and they're just like, Tim, what do I do? If it's mid-range or midday or at a random price, I don't know what to do. Every trade I do should be based off a breakout, a dip off, a new high, or a breakdown at or near support resistance levels. Okay, I'm using technical analysis as my guide on every single trade. I don't want to just be in a stock randomly because I don't know what a random stock and at a random price is going to do. I judge my stocks and my trades and my risk reward levels based on, what the chart is telling me. And the chart needs to have a breakout or a breakdown for me to even be interested in it. Buying or shorting mid-range is very dangerous and it leads to lower odds of success. Some breakouts don't continue. That's okay, but at least there's a breakout. And if the breakout doesn't continue, that's when I cut losses quickly. Some breakdowns don't continue breaking down. If I'm shorting a stock and it just keeps making new lows and then it stops making new lows, and I'm like, well, what do I do? Well, that's when I cut losses quickly, or I cut the trade quickly. Sometimes I even take profits too quickly because I'm just like, well, it didn't break out the way that I wanted. As I'm filming this, I sold a stock just before I finished this DVD today, just before I started working on it. And I made, what was it? I bought the stock at like a buck 58, I think. And I wanted to make 20 to 40 cents a share on it. ALIM was the ticker. And I wanted to hold overnight. It's an earnings winner, and I'll talk more about that. But it could not break through 174. There was a giant wall of sellers right before the close, and I was just like, the breakout, I mean, yeah, it's a breakout, but it's just not continuing. And even though I didn't have a loss, I exited because, again, this is also where my personal schedule comes in, where I'm trying to get this DVD done before I go to the Maldives. So and I'm going in 4 days. So my next few days, I am crunching recording this. I have the whole presentation prepared, but recording takes time. So in this case, I'm going to favor my personal schedule, especially when the stock didn't really show me that much love. The price didn't show me exactly what it wanted to do before the market closed. That said, though, when I just took a break from recording this DVD, I looked after hours and the stock was in the 180s. So maybe I did play it too safe, but I tailored my trade to my own personal cowardly preferences and my own personal schedule. And I want you to be able to do that too. You don't have to try and rearrange your real life around trades. Maybe if the stock had continued uptrending nicely, I would have held and I would have said, you know what, I can record after I exit this trade tomorrow. But it just didn't give me the confidence that I needed to hold it overnight and to take away from my precious recording time, since it's coming down to the deadline. I share all of this with you. It's not because I want to overshare. It's because I want you to understand that I fit trading into my own schedule. Trading does not overwhelm me. Okay, even though yes, I did miss my college graduation, and in the past, yes, I have ditched friends and family. Lately, I've been getting better, and I've been tailoring my trading around my own schedule. So you have the choice. But no matter what I say, learn the patterns that I teach. Study my guides, study my video lessons, and study your history. Okay, this is why I now have 4,000 plus video lessons on Profitly. Now, I know that sounds like a lot and it might sound overwhelming, but the way that I number the video lessons, they're only 5 minutes long each. So, let's do some math here. Hold on, let me get some calculator out. I'm going to do this so that you can see I'm not good at math. I think we're at 4,015 right now times 5 minutes. So we're at, I don't know, 20,000 roughly. So we're at 334 hours worth of video lessons. But again, I am a glorified history teacher. So you can not watch my video lessons. You don't have to. But I think that it's going to hurt you, maybe even just a little bit, maybe like a penny on every trade that you don't watch a video lesson, because you're not going to be aware of a past trade. You're not going to be aware of a past pattern. You can get experience yourself. You can learn everything that I've learned in the same 20 years, maybe 25 or 30 years, because no one has a work ethic like me. But if you learn the history of these patterns, you are better prepared. Studying the past, studying the present helps you be better prepared for the future. And that's what this is all about. So let's get into some patterns because they're fun and I love them so much.
My name is Tim Sykes, and I teach people to trade stocks. I am a self-made multimillionaire.
So this is the ideal trade that I'm going to talk about. I want you guys to understand every single aspect of this trade.